Supermicro Computer Inc. concluded its latest live market session on Friday, May 22, 2026, at 4 p.m. EST, locking in a final closing price of $35.58 per share. This represents a solid intraday upward move of 6.31% on the day, with the stock swinging between an intraday low of $33.68 and a high of $35.94 before settling into the weekend. Because the market is currently closed for the weekend, these figures represent the official closing baseline before trading resumes next week. This recent single-day surge of over 6% looks like a massive win on the surface, but the real narrative inside the options chain and institutional order flow tells a completely separate story. While casual retail buyers are chasing the headline pop, massive block trades are quietly hedging against a severe cash flow crunch that the broader market seems to be overlooking. The expectation among mainstream participants is that this server manufacturer is finally stepping out of its operational nightmare and reclaiming its position as an unshakable hardware giant. The underlying reality is that the firm is burning through capital at an unsustainable pace to keep up with order backlogs, leaving its balance sheet incredibly vulnerable. To understand why this gap between perception and reality matters, you have to look at the collective psychology dominating the investing community right now. The common ground among most market participants is a belief that liquid cooling infrastructure and specialized server racks are guaranteed tickets to long-term wealth. People look at the massive computing footprints being built globally and assume that anyone building the physical enclosures will automatically print cash. But the contrarian view, backed by the latest financial filings, reveals that hardware assembly is a brutal, low-margin game where scale can actually become an operational trap if your supply chain costs spiral out of control. Recent stock movements have been nothing short of a roller coaster, driven by immense trading volumes that regularly exceed 30 million shares a day. This intense churn shows that institutional investors are aggressively repositioning their portfolios. The primary catalyst for the daily swings has been the reaction to the mixed fiscal third-quarter results. The headline figures showed a massive 17% miss on top-line revenue expectations, which initially sent shockwaves through individual brokerage accounts across trading platforms. However, the stock experienced a swift 17% post-earnings rebound because the non-GAAP earnings per share managed to beat estimates by roughly 33%. This bottom-line beat was driven by a sharp recovery in gross margins, which climbed back to 10.1% from a dismal 6.4% in the previous quarter. This margin recovery is exactly what sparked the recent buying frenzy on major investing sites and mobile apps. Mainstream investors interpreted the jump to 10.1% as a sign that pricing pressures were easing, yet a deeper look into the guidance reveals that management expects margins to contract right back down to the 8.2 to 8.4% range in the upcoming quarter. This projected drop is due to rising input costs, expensive freight logistics, and the exhaustion of older, lower-cost components that temporarily boosted profitability. When professional traders noticed this detail, institutional volume shifted toward deep out-of-the-money put options to protect against a sudden reversal. The structural health of the balance sheet is causing significant concern among credit analysts. While the equity market cheered the earnings beat, the company's operating cash flow collapsed to a negative $6.6 billion. To sustain production and build out massive liquid-cooled server racks, working capital requirements have expanded exponentially, forcing inventories up to a staggering $11.1 billion. This inventory accumulation has been funded almost entirely by taking on massive amounts of debt. The company's net debt now stands at $7.5 billion, a material increase that drastically changes its risk profile. For investors practicing self-investing through platforms like Robinhood or Interactive Brokers, this leverage adds a layer of volatility that standard valuation models fail to capture. Macroeconomic pressures are further compounding these balance sheet risks. With interest rates remaining sticky, servicing $7.5 billion in net debt becomes an expensive endeavor that eats into thin operating profits. Sector momentum has also turned highly fragmented. While major component designers enjoy immense pricing power, the hardware integrators are forced to compete fiercely on price to secure large-scale data center contracts. This structural dynamic has triggered significant short seller interest, with high short interest ratios keeping daily price action highly sensitive to macro indicators and sector news. To get a sense of how retail sentiment is shifting, comment below how many shares of Supermicro Computer Inc. you currently hold in your portfolio. Seeing how everyday investors are positioned across different brokerage accounts provides excellent insight into whether retail money is still trying to catch this falling knife or if the broader market is starting to step away.
Beyond the immediate financial metrics, the corporate governance landscape has introduced a heavy risk premium to the stock. The company has faced severe headwinds over the past year, including high-profile auditor resignations, delayed financial filings, and an ongoing Department of Justice investigation into its accounting practices. Although the company recently appointed a new chief business officer and a new chief revenue officer to stabilize its leadership team and rebuild trust with institutional clients, these regulatory clouds continue to cap valuation multiples. This explains why the equity currently trades at a forward price-to-earnings ratio of just 12.9x, which is a massive discount compared to the broader technology sector and its own 5-year historical averages. Now, let us strip away the recent trading chaos and focus entirely on what this business actually does. The company designs, manufactures, and sells high-performance service solutions built on open architectural standards. Its core business model revolves around what it calls modular architecture, allowing it to customize server configurations for enterprise data centers, cloud computing, and high-performance computing clusters. Instead of selling standard off-the-shelf servers, the firm integrates motherboards, power supplies, chassis, and cooling systems into highly specialized units tailored to specific compute workloads. The primary growth driver for this model is its direct liquid cooling technology. Modern high-density compute clusters generate immense amounts of heat, making traditional air-cooled data centers inefficient and incredibly expensive to operate. Liquid cooling circulates fluid directly across the most intense heat sources inside the server, allowing data centers to pack more computing power into a smaller physical footprint while drastically reducing electricity bills. The company has aggressively expanded its manufacturing capacity to support the assembly of thousands of these liquid-cooled server racks every single month, attempting to position itself as the physical backbone of global digital infrastructure. Historically, this business operated as a relatively quiet niche hardware provider. Over the past 5 years, however, the business model experienced an unprecedented demand shock. Revenue grew from modest levels to projections targeting billions of dollars annually. This explosive top-line expansion drove the stock from a low-profile small-cap name to a prominent component of major market indexes, creating immense wealth for early investors who bought shares through legacy online investing platforms. But this historical surge came at a cost. The rapid scale-up completely overwhelmed internal financial controls, leading to the severe accounting delays and governance breakdowns that plagued the company throughout recent history. Past financial reports highlight a dangerous trend of customer concentration that remains a core risk today. In previous quarters, a single confidential customer was responsible for roughly 63% of the company's total revenue. This means the entire operational health of the enterprise rests on the capital spending budget of just one or two massive entities. If that primary customer decides to diversify its hardware suppliers, pause its data center expansions, or build its own server integration facilities, the company's revenue pipeline could instantly dry up, leaving it with billions of dollars in specialized unsold inventory. Looking forward, the future outlook for the company splits into two distinct highly volatile scenarios, where the tension between expectation and reality will ultimately resolve. The bullish scenario relies entirely on the company hitting its aggressive long-term revenue targets. Management has expressed immense confidence that global demand for advanced hardware infrastructure will push its total revenue from $40 billion towards $60 billion over the next few years. In this narrative, the massive $11.1 billion inventory is not a sign of operational distress, but rather a necessary stockpile of expensive components required to fulfill a massive backlog of guaranteed orders. If the company can successfully deliver these systems while maintaining a gross margin above 10%, its current forward valuation of 12.9x earnings will look incredibly cheap, potentially sparking a massive upward re-rating that benefits long-term holders using automated tools like Schwab Intelligent Portfolios or active trading accounts. The bearish scenario, which aligns closely with recent short seller thesis, views the business as a textbook value trap. In this outlook, the sudden margin recovery seen last quarter was a temporary anomaly rather than a sustainable trend. As major technology firms begin to scrutinize their infrastructure expenditures, pricing power will shift entirely back to the customers. The company will be forced to cut prices to secure high-volume contracts, compressing gross margins back down toward mid-single digits. Combined with the high cost of carrying $7.5 billion in net debt and the potential for regulatory penalties stemming from the ongoing federal investigations, this margin compression could severely restrict net income, turning that massive inventory stockpile into a massive write-down hazard. When you evaluate this company alongside other major tech giants, the contrast in financial stability becomes glaringly obvious. Investors often look at high-flying equities like Tesla stock, Apple stock, or Nvidia stock and assume that all technology hardware businesses enjoy similar cash flow profiles and competitive moats. But those companies possess proprietary software ecosystems, custom silicon designs, or massive consumer brand loyalty that insulate their profit margins. This enterprise, by contrast, operates in a highly commoditized hardware assembly market where switching costs for customers are relatively low, meaning its operational survival depends entirely on execution speed and capital efficiency. To wrap everything up, the core of the investment thesis comes down to weighing an attractive, discounted innovation against severe structural risks. The central insights show a business caught between incredible top-line market demand and intense internal balance sheet strain. The expectations of a clean, friction-free operational turnaround are directly contrasting with the reality of negative $6.6 billion in operating cash flow, massive inventory inflation, and sticky regulatory headwinds. The recent 6.31% daily upward move to $35.58 shows that the market is highly reactive to short-term earnings beats, but the long-term long-term trend will be decided by whether management can translate its massive revenue scale into actual positive free cash flow. Until the company proves it can self-fund its operations without relying on continuous debt issuance, the stock will likely remain a highly speculative battleground for traders across every major trading platform.